evening, everyone. Thank you so much for taking out time for today's session. Well, it's almost 4:30, and I know it's generally tea time for all of us in India, but it's okay. वैसे भी इंडियन कैपिटल मार्केट्स ने काफी लोगों की नींदें उड़ा के रखी है. I remember my father, he always used to say something, good times or bad times, ये वक्त भी गुजर जाएगा. Remember that line, ये वक्त भी गुजर जाएगा. So for all our dear Indian investors, I'll put it like this. I hope ये market भी सुधर जाएगा. But what is important for all of us in this room is to understand that this is a time of opportunity and why we as Indians have restricted ourselves to exclusively investing in Indian capital markets. In fact, we are now blessed with something like a gift city. And gift city is like a boon to all of us. In fact, not just for us. And if I'm not wrong, GIFT City is at par with many other international financial jurisdictions like DIFC, Singapore, Mauritius, etc. A global setup financial hub which helps you to both do inbound investments as well as outbound investments. Let's be honest, all of us have always loved to own a lot of international brands, right? From Mercedes to, say, a Ferrari, from LV to Gucci, from Prada, what else? We've always loved owning international brands, using them personally as consumers. So why not invest in those companies which we've trusted for years? In fact, what is shocking is the Hurun's report, which was released in 2024. I would like everyone to take a pause and look at this slide. It shows that investors in developed capital markets generally invest up to 30 to 40% of their wealth in equities or assets of other countries. But ironically, in India, this allocation is a mere 14%. Can you see this pie over here? It's mere 14%. And out of this 14% also, only 10% only 4% goes to equity and 10% has gone to real estate. So, a lot of people have gone out and purchased real estate for commercial or business purposes or for, residential purposes globally. So like I said, we as Indians, we love to play in our home turf, in our home ground. But now that we are blessed with something like GIFT City, we have so many funds, all of them regulated by an authority like IFSCA. There is a plethora of opportunity if we want to look overseas. And in fact, I personally feel that there is no better time than now as to why one should look to invest internationally. First and foremost is diversification. You know what? Diversification is the first rule of investing. Don't put all your eggs in one basket. Correct? We've heard that time and again. When we tend to invest only in a single market, whether it's our home country, we tend to carry a concentrated risk, a risk of single market exposure. Just the way we've seen that industries have cycled, countries too have boom and bust cycles. And to make outsized returns in such competitive markets, we need to actually identify which is the capital market which has not performed for quite some time and where else can we go and invest globally. The second important point, but before I come to that, we are Indians, and we love playing cricket, right? We love playing cricket. We applaud every century, that is made, especially if it's by Virat Kohli. But there's something that's racing towards a century. And trust me, no one in this room would love it when it hits that score. Any guesses, what it is? Our very own INR. INR dollar is playing in its nervous 90s. And my fear, it's going to touch 100 probably soon. Reason? India is inherently an importing country. Trade deficit runs high and our currency tends to weaken. In such a scenario, when we invest in global equities, it actually acts as a hedge against the falling currency. Third, very, very important, Indian markets have had a phenomenal run over the last 4 to 5 years. We've all made a lot of money thanks to the good growth that the country has given. Also, the buoyancy in capital market. A part of these returns have actually got amplified because of a lot of stimulus. But like it or not, today we are in a zone which is out of margin of safety. What is margin of safety? If you look at this slide over here, we have the red box where you can see Nifty 50, Nasdaq, BSE mid cap, BSE small cap. The 5-year CAGR return in these markets have roughly been in the range of 25 to 30%. In fact, even higher in case of small and mid cap. But today they are all quoting at very peak valuations, close to 30, 35. In fact, any good company today is quoting at a PE of 40 or 50. In a scenario like this, how do you make money? If at all there is a black swan event, we are at the brim of a correction and things might just collapse. Interestingly, if you look at the green box, these are those capital markets which over the last 5 years have hardly generated returns in the range of 0 to 10% in terms of CAGR. And they are still quoting at very, very cheap valuations. Now, the question to you will be, if they have not yet performed, why should now we look out into these markets? The reason is very simple. There is a cocktail of stimulus that is being announced in many of these countries, whether it's China. You've heard last year they came out with this big, domestic consumption boom, stimuli packages, a lot of other stimulus that they've been doing towards their capital market stuff. Germany has come out recently with a $500 billion stimulus package. That's almost 12% of their GDP. In fact, entire Eurozone, if you look at the entire Eurozone, they are in a fiscal expansionary policy mode. In a situation like this, what happens? Capital tends to follow those countries where stimuluses are being announced because stimulus lift the economy. So I think there are many compelling reasons. And most importantly, last but not the least, we Indians are blessed to have a gift in the form of GIFT City. We have more than 300 funds, and I think Maulik just told you all about those numbers. We have so many funds based out of GIFT City. A lot of them are inbound funds which help international investors invest into India, but quite a few, or I'll rather say a sizable chunk, which is helping investors invest outside India. So yes, of course, it's very, very important to invest internationally. But let's move on to the question as to why invest, to how to invest in international capital markets. While the easiest way probably would have been to participate in any international equity through mutual funds or ETFs, etc. So, there are a lot of mutual funds in India like Motilal Oswal Nasdaq 100 or something like Edelweiss Greater China. These are basically mutual funds that invest in the overseas mutual funds. It was the easiest way to participate in international markets. You need to identify a good fund manager, a good fund house, and go ahead and participate in their portfolio. Alternatively, we also have a lot of exchange traded funds. These are international ETFs. Basically, they are listed on our very own NSE BSE, and they track a foreign index, something like a Nippon Hang Seng ETF, the Mirai Hang Seng ETF, the Motilal Oswal S&P 500. These are ETFs which are available on our exchanges. All we have to do is log into our demat or trading accounts, click the buttons and buy them, just like we, buy our stocks or ETFs. But you know what? SEBI and RBI don't like it when we take the money out of India, correct? And there are regulatory, prohibitions in terms of the total outflow that one can actually take. In fact, there is an overall capping of USD $7 billion, close to 63,000 INR crores. That is the max amount investors in India can invest and deploy in international mutual funds through India. Unfortunately, if you guys have not yet taken that bus, you've missed the bus. Because we've already breached that limit. So ab kya kare? Don't worry, as I said, we have GIFT. So let's see what GIFT has to offer us. Basically, if you look at GIFT City, it has the capability to actually invest in overseas market outside these SEBI and MF limits of $7 billion. And the scope of investment is available to everyone, whether it's OPI route or through the LRS route. Indian corporates, LLPs, partnership can participate through the OPI route. Resident Indians can participate through the LRS route. In fact, there is a combination of retail funds and non-retail funds in GIFT City. Retail funds, start with a very, very low ticket size of hardly 5,000 to, 10,000, 15,000 kind of dollars, around $1 lakh, 2 lakh kind of a thing. You can take exposure into these international, equities. The benefit of investing in GIFT City based funds is that, they curate portfolios for the clients. for the fund. They are not a feeder fund, unlike the mutual funds that we spoke about in the last slide. The mutual funds go ahead and invest in other mutual funds. It tends to be expensive. They trade at a premium, right? You have dual expense structure because the principal mutual fund will have its expense ratio. The secondary mutual fund will have its own expense ratio. Interestingly, funds which are based out of GIFT City, the AIFs, whether it's Cat 1, Cat 2, Cat 3, they can directly invest in global securities. And hence, the expense ratios are comparatively far lower. And ticket sizes, as I said, for retail funds is quite low. If you want to have a more sophisticated investment approach, you can also approach non-retail funds, which are structured as AIFs or PMS. It gives you greater flexibility. In fact, we at Aequitas have two such funds. One is the Aequitas Far East Fund, and the second one is the Aequitas Global Value Fund. We are investing into direct securities on Hong Kong Exchange, European exchanges, American exchanges. The route to investing in these AIFs is very simple. The first route that I'll deep dive into is OPI, which stands for Overseas Portfolio Investments. It's kind of opposite of FPI, Foreign Portfolio Investment. OPI was a rule that was, that came out in 2022. So FEMA came out with these regulations. They've been issued by RBI. And the good part about this is that any corporate entity like a registered partnership, an LLP, or a private company which is incorporated in India can invest up to 50% of the net worth of their entity as per the latest audited financials into any of the GIFT City based funds. The beauty is that, you can right size your check. A lot of investors, they really want to take out or have a significant exposure. But due to LRS limits of $250,000, you really can't, right size the check. So OPI gives you this advantage. You can right size your check, basis your own net worth or the net worth of your entity. Second very good thing about OPI is you do not really need an RBI pre-approval, etc. when you decide to invest into these securities. This is a rule that is available to be utilized by any of the corporate entities. All you have to do is there is a disclosure requirement that needs to be done, that you need to submit to the AD Bank or the RBI every 6 months about the investments that you have made via the OPI route into any GIFT City fund. Second one, I think more people in the room would love to hear about this. LRS, or the Limited Remittance Scheme. In fact, it was just 2 years back that I did my first LRS. Before that, I had never even, tried international investing. So LRS basically stands for Liberalized Remittance Scheme. It is a scheme of RBI which allows all resident individuals, including minors, to freely remit up to $250,000 every financial year for any permissible transaction. Now, what are these permissible transactions? Your foreign travel, something like your kids' education, any medical expenses that you take internationally or incur internationally, any expensive machinery that you import, etc., for your personal purposes, etc., and all. These are all part of LRS limits. And any individual can actually invest up to $250,000, through this route. In fact, a family of 4, including minors, can, by this route, invest up to $1 million into any, international fund, whether based out of GIFT City or otherwise. But this route is available only to individuals. It's not available to corporates or partnership firms, or for that matter, trusts, HUFs, etc. One very important thing that one needs to note down about LRS is that there is a TCS component, something akin to TDS. TCS stands for Tax Collected at Source. So any LRS transaction that we do beyond 10 lakhs attracts TCS of 20%. So suppose you decide to invest 1 crore into international equities, up to 10 lakh is exempted. On the balance 90 lakh, you have to pay a TCS of 20%, which is almost 18 lakhs. Again, government is generous. You can adjust this TCS amount against, any kind of advanced tax liabilities, whether it's in the form of capital gains or, income from business or profession or any other, salaried income. People can also adjust it under Section 192, whatever TDS is being deducted. You can just tell your employer and ask them to adjust this TCS amount against the TDS that they would have deducted otherwise. If you do not have a big tax outlay, the TCS comes back as a refund in your income tax refund. So it's quite an easy approach to international investments. I personally have done it when I invested in one of our funds, and it hardly takes a day or two. You just have to go approach the bank and let them know that you want to do this transaction. It's a dollar transaction or a euro transaction. You just have to tell them this is the amount that I need to transfer, and a forex rate is fixed, and you can easily transfer the money. Now, coming to the important part, being a CA, I think this is a very, very important thing for me, because it's not just returns. What's important is the net of tax returns, right? See, taxation is very important, and taxation is something which is critical, especially in international financial or investments, because interestingly, there is no capital gains that foreign countries levy when we go ahead and invest into their countries. In fact, most of the source countries do not levy any taxes on non-resident portfolio investors. Yeah. Gives us some happiness. Kahin to gains पे tax नहीं देना पड़ रहा. But dividends पे tax देना पड़ता है. Some countries, tend to withhold, and charge a withholding tax on the dividends that is distributed by the portfolio companies. But when you invest via any fund, or via any GIFT City based fund, etc., these funds try to take advantage of double taxation avoidance agreements. Hence, the net impact of taxation at the source country where you are investing is negligible. But very important thing that all of us need to note down is that when we finally bring this money back to India from the GIFT City location, then it is subject to long-term capital gains and short-term capital gains tax. Long-term period is 24 months. Short-term period is less than 24 months. Unfortunately, short-term gains are taxed at the highest MMR. So it's MMR plus surcharge plus cess, makes it around 35 to 40%, depending upon, what kind of bracket you're in. LTCG is simple. It's 12.5% plus surcharge and cess, in line with, the long-term capital gains rate that we pay for Indian equities. The only thing that one needs to take care of over here is that the long-term period is actually 24 months, which is 2 years and not 1 year. One very, very important thing, so far as AIFs is concerned, there are two different categories of AIF. In general, you have Cat 1 and Cat 2 AIFs, which are not the pass-through entities. So any taxes that, is the ultimate liability of the investor who has invested into the fund. So probably the funds calculate the amount, which is your tax liability, and all you have to do is go and, pay those taxes after the redemption. But in case of Cat 3 AIF, there's one more advantage. All the taxes are to be borne by the fund itself. So the investor, whenever he redeems the money, those redemption proceeds are distributed to AIF unit holders post-tax. So the investing client is not liable to pay any additional taxes upon redemption. Their NAVs are generally adjusted, with the fees and the taxes. And you don't even have to, take the headache of, अरे DTA था कि नहीं था, मैंने यहाँ पे इतना टैक्स दे दिया, वहाँ पे इतना टैक्स दे दिया, क्या एडजस्टमेंट करना है. All that will be taken care of by the fund house. So it becomes quite easy breezy for the investor. All he has to do is just put the money, deploy it, and stay invested at least for 2 years, because otherwise, a big pie of the gains will actually end up being with Government of India and not you. So yeah, I mean, stay invested, have a long-term approach to investing, especially in international equities, and the tax liability will be taken care of by the funds. In terms of reporting, again, things are quite simple. If you have invested by a GIFT City-based fund, GIFT is actually considered a deemed foreign territory for foreign exchange laws in India. Hence, any investment that you make through these funds is actually not required to be reported as a foreign asset. The only thing that we need to take care of is that, if you have invested via the OPI route, you have to actually fill in some specific forms like, form OPI, and, timely report to the authorized dealer that this is the net investment that I have made during this quarter or this 6 months. I think there's a 6-monthly reporting if you have made any additional investments, etc. So it's more like an ad hoc reporting. as and when you do those investments within the 6 months, depending upon the period, September and March, you have to come back to the AD Bank and the RBI that these are some of the investments that I'm holding internationally. So far as LRS is concerned, the only thing, as I explained you all earlier, is the TCS aspect. Once the government is aware that you've done some LRS transaction, they deduct the TCS and you can claim it as refund. There's no additional reporting that you have to do at the time of redemption. Of course, whatever proceeds will come. If it's through a Cat 3 AIF, you have to showcase it as income exempt from tax or income which has already been subjected to taxation. Your chartered accountants will take care of it. We have quite smart ones in the country. I'm one of them, and so is Maulik. And yeah, these are some of the regulatory disclosures that one needs to take care of. Happy to answer any queries that any one of you have. I have been a part of Aequitas. We are close to $1 billion fund house today. We invest in Indian equities as well as global equities. So my exposure to global equities has happened over the last 2 years when the fund decided to go overseas through its Far East fund. We also have launched a global value fund now, which invests across the globe into 3 continents, primarily Europe, US, and Asia. And more than happy to answer any queries that you guys have.